Hi, I'm Joe Wallen. If you own qualified small business stock, or you're thinking about issuing it, the rules just changed. In the next few minutes, I'll walk you through the new 3, 4, 5 year holding period under the One Big Beautiful Bill Act and what it means for your tax planning. Here's how Section 1202 used to work. You had to hold your QSBS for at least 5 years. Clear that bar, and 100% of your qualifying gain was excluded from federal tax. Sell one day early, and you got zero. It was a true cliff, all or nothing. And this rule still applies to any QSBS issued on or before July 4th, 2025. The new rule: for stock issued after July 4th, 2025, the cliff is gone. Hold for 3 years, you exclude 50% of the gain. 4 years, 75%. 5 years or more, still 100%. That's a meaningful shift. Earlier exits now get real tax benefits instead of nothing. But here's the catch most people miss. The portion of your gain that isn't excluded doesn't get the normal 15 or 20% long-term capital gains rate. It's taxed at 28%, and you still owe the 3.8% net investment income tax on top. So before you celebrate a 3-year exit, run the math. Sometimes waiting for the full 100% exclusion is still the better deal. So which rules apply to your stock? It all comes down to July 4th, 2025. Stock issued on or before that date lives under the old regime, 5-year hold, all or nothing, 10 million or 10x basis cap, 50 million gross asset limit. Stock issued after that date gets the new rules. The 345 tiered exclusion, a 15 million cap that's now inflation indexed, and a 75 million gross asset limit, 2 parallel regimes. Old stock keeps old rules. Critical warning: this might be the most important slide in the deck. Do not try to refresh your old QSBS. You cannot swap pre-ABA shares for new shares to capture the better terms. If you try, you will likely destroy your QSBS status entirely. Old stock, old rules. New stock, new rules. Don't get cute with this one. Planning implications. So what actually changes? 3 things. First, the holding period is now a planning dial instead of a cliff. You can weigh an earlier exit against a larger exclusion. Second, secondary sales and tender offers at the 3 and 4 year marks now carry real tax advantages for founders and employees. And third, if you've been sitting on an LLC or S Corp wondering whether to convert to a C Corp, the math looks better today than it did a year ago. For the full breakdown, QSBS requirements, stacking strategies, and how Washington State treats all of this, head over to the startuplawblog.com. Subscribe for more on startup law, tax, and equity planning. I'm Joe Wallen. Thanks for watching.